Well, let's get straight then, Mangalam, to our first management. We have Mr. Nitin Rakesh, the CEO and MD at Mphasis, who joins us now. Hi, Nitin. Thanks so much for joining in. Always a pleasure talking to you. Well, give us a sense in the part of the business that did well in the past quarter. That's the direct core business. The growth over there was very, very strong. Was it the large clients, the erstwhile clients? Is it new clients? Or is it the Blackstone portfolio that really fired for you? Give us a sense out there.
Sure. Thank you for having me. So I think on the direct side, the performance is actually quite broad-based. There are 4 or 5 drivers of growth that consistently have given us good revenue growth. Firstly, this was a record TCV win quarter in the direct channel. So clearly that's a third quarter of 200 million plus net new TCV wins. This was a 360 million a quarter, highest ever that we've ever done. So I think that momentum of deal wins is translating into revenue growth. We are seeing good growth from existing large strategic accounts. We've consolidated our position despite all the vendor rationalization efforts and everything around, consolidation that we heard about. We've also seen good growth from, new clients. In fact, they've grown 30% year over year in this quarter. We've definitely seen good growth from our European business as well. I think very, very strong growth, there for almost 6 quarters now. And this particular quarter, it was in the direct business almost 27-28% on a YY basis. So I think it's been all-rounded, well conceived, and broad-based growth.
All right, fair point. Broad-based growth is what you're seeing, Nitin. So in that case, what sort of revenue outlook do you have for the remainder of this year? This morning we were speaking to Coforge, and they believe 6% constant currency growth this year is possible. You did it in the second quarter. What about the next 2 quarters?
Yes, I think 2 things to note there. Firstly, we've already crossed our pre-pandemic peak revenue in Q2. We crossed it by almost 7 million in this quarter. Previous peak was in Q4 of 20. We also called out for the fact that our growth will recover from sequential basis Q2 onwards, and we even in Q1, which was the crisis quarter, we actually didn't decline on a YY basis. So I think if we continue the trajectory, you can definitely look at the current growth rates being sustained on a YY basis.
The year, what should that number look like?
Probably mid to high single digits.
Mid to high single digits. All right. The problem in the business is this DXC business. Now that's gradually been coming down, and that's really the only part of these numbers that we've been looking at, whether it's this quarter or a couple of quarters earlier as well. Tell us what's going on there. What is the minimum revenue commitment that you're getting from them, and when does this expire? By September 21, right? So isn't that a risk?
So I think, we've obviously over the last 6 quarters, we've been working fairly diligently on making sure that we grow everything else around it. And I think we've been fairly successful in not letting those declines, especially in the last couple of quarters, derail the overall company momentum. I think we have another 4 quarters, roughly 200 million of MRC that is still left to be consumed. Obviously, there will be some seasonal variability and quarterly volatility, but broadly, I think that gives us a good guideline to September 21. And I think from that point onwards, it will become like any other client for us, because in every customer that we compete in and do business in, we have to show value and earn business, and that's how we think this will play out as well post September 21. So we're not really worried about it per se. We believe that we have good positioning, good set of capabilities, and we'll continue to find ways to work with every customer, including them.
Right, interesting there. If you could tell us a little about your margins, because that was one of the things that stood out this quarter as well, 16.1%, that was a sequential recovery. You have a guided band of 15.5 to 16.5. Which end of this band do you think you'll end this year in, and would you change the band itself?
No, I think so far we've not changed the band, because the philosophy that we decided to follow early on in the year, especially as we saw the crisis being hit and the opportunity to actually accelerate some of our deals and deal wins with customers. The primary philosophy was that we'll try to make sure that we can maximize the growth potential that exists in the market today, given just the fact that we have a competency-led growth model where a lot of our digital transformation capabilities are in high demand right now. So we prioritize growth over margin expansion. We've held the margins steady. Of course, they've improved 40 bps QOQ. But we do expect to operate in the same band because we are taking a lot of the margin operating leverage that we are getting from the current environment and reinvesting it back in either competency build-up or sales expansion. And in many cases, we're also using some of that to invest for the ramp-up of the deals that we've been winning over the last 2 quarters.
All right, Nitin, thanks so much for stopping by. The numbers have been looking good. You're sounding rather confident as well. High single-digit revenue growth. Wish you the best for the second half of this year. But clearly, the business besides DXA has been doing pretty well. Well, on that note, though, we'll slip into a short break. You come back, we'll continue our focus on markets. We'll also get in a couple of other managements on the other side. Don't go anywhere.